All right, we're live. Welcome to the show. Be the boss of your money. This show helps explain things like why is the stock market going down so much? What happened? The suddenness of this summer swoon is so sudden that people are having trouble wrapping their minds around it. Oh, and diversification, we always say it's a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. And boy, oh boy, the last few days, especially today, are a perfect example about that. We're going to get into what happened, why, what to do next. And more importantly, I want to talk about what not to do because people make the same mistakes over and over. So I want to identify a few of those. So let's roll a quick intro. We'll get into it. If you have any questions, you know what to do. Ask in the comments. I'll see them. Even if you're not watching this in the live stream and you're watching a replay because it's on our timeline, ask away in the comments. I'll see them. I'll answer them. I have Bobby and Andrew here as well, and they can answer them too if it's something that I feel needs more color or if it's something that I need more information on. So you're going to get really good answers from us. So I want you to take advantage of the show. Give us a thumbs up. Also, if you're watching on YouTube, please subscribe. Here is the intro. Okay, first, sip of coffee. Today was a big coffee day. Not just because it's Monday, but just, so much going on, keeping the energy levels up. It's an interesting day. You see, I don't look at stocks up or down as necessarily, oh, a good day today, I'm happy, or a bad day, or I'm sad today. My mood does not depend upon what the stock market does on any given day, quarter, or even year. It's all information. It's all very interesting to me. And that's what I like. I think one of the reasons I love my job is I love people, I love the market, I love to put those together. And both could be unpredictable, and yet both are predictable. So let's get into it. What happened? Stock market a couple weeks ago was at all-time highs. The major averages were all going up, up, up. Artificial intelligence was leading the way. Everybody wanted in on the action. The more they went up, the more people wanted them, even though the more they went up, the less people you would think would want them. The stock market's the one place where when prices go up, more people want them. Everything else, whether if you're talking about goods or services or, I don't know, sunglasses, whatever you're talking about, when prices go up a lot, you typically get less volume. And then when the manufacturers start getting less volume, they do things to lower their cost, lower their prices to you, so that prices go down and you'll buy more. That's a pattern in life, except when it comes to the stock market. When the stock market goes down, people don't look at it like stocks are on sale. They look at it like there's a problem. And stocks go up and people say, "Oh, things are good. Now that we're all clear, I'm going to buy." And people do the same thing over and over. So what happened and what should you do? And what could you avoid? So let's get into that. A number of things happened, but the swoon you're hearing about today that you've been watching all day has already been underway. Yeah, it accelerated a lot today. But, last Friday, the NASDAQ already entered a 10% correction. Okay, we typically define 10% down from a recent high watermark in any index as a correction, 20% down as a bear market. And that is what happened with the NASDAQ. And now the Dow is not far, maybe it's 6-7% below its all-time high. It could easily go into a down market, and it wouldn't surprise me either way. But typically, the major averages, Dow, Nasdaq, S&P 500, they typically do have one correction or a year. So I can't tell you if we're getting it. Doesn't mean like, oh, we got it over with. Now we're not going to have any more. Markets go up and down without rhyme or reason, often without warning. Like now, the market's going down. It started to go down, and people want like a reason or a pinpointed exact move of when the stock market started to go down. But basically, it's not that the market had to start to go down. It's just that the market went up too much. Obviously, went up too much because it went down, right? If it didn't go up too much, it wouldn't have gone down. That makes sense, right? And I always like to say that if you want to know what consumers are doing, watch stocks like Target, like McDonald's, like Kohl's or Starbucks. But if you want to know how the stock market's doing, watch the Magnificent Seven. We used to call them the FANG or FANG M stocks. But, the seven biggest stocks, Tesla, NVIDIA, Facebook, Apple, Alphabet, Amazon, Microsoft. You know these names. We talk about them all the time. When they're going down, it's impossible for the S&P and NASDAQ to overcome that. Well, it's almost impossible because they have such a big weighting in those two averages that the bigger they are, the more of an impact that they have on those averages. So when they go down a lot, they drag everything else down with them. And plus, everything's been going down, and all 11 sectors of the S&P 500 are down today. So very few stocks were spared. There were a couple of stocks that are up today. I'm not saying there weren't a few stocks that are up today, but by and large, if you're looking at your overall portfolio, you were probably down pretty good today. And finally, we're getting a little help from the bond market because bond funds are starting to recover some of their massive losses from a little over 2 years ago. Not enough to really offset what happened in the stock market today, but at least there were some things that went up today. And if you listen to us, I know that sounds so self-serving, but if you work with us, you probably have a pretty good slug of individual bonds and treasuries and munis and things like that. And that was a big help because those did well, and we locked in good interest rates. Listen, I was all over this. Just saying, don't just buy 6-month or 3-month T-bills. Go out 2 years, 5 years, even 10 years. We talked about that 10-year bond when it was 5%, what a deal that was. But people are like, well, I could get 5.25% in a 6-month. Now the 10-year is down to 3-point-something percent, 3.7, 3.6. And we're going to see, we expect to see, I can't say we should for sure. We expect short-term rates to go down because we expect the Federal Reserve to cut rates. They don't have to cut rates. It's just based on the news we've seen, based on how the market's reacting, based on what pundits are saying, and based on indications from the chairman of the Federal Reserve himself, Jerome Powell. We all expect a rate cut in September. So the market's been going down already. The artificial intelligence stock hype has been letting a lot of air out the last couple of weeks. You've seen it, especially with stocks like NVIDIA, Broadcom. They've all been, sorry, I'm still stuffy from my cold last week. They've all been coming down, and they just accelerated today, and they went down a lot this morning. Some of them rebounded off lows, although the major averages still closed down a lot. The NASDAQ bounced off its low, but still everything was down pretty good. Pretty good. It's a new term I just made up. So today's excuses or reasons, and I want you to know, we often don't know the full reason or reasons why stocks go down until some time has passed. But the reasons now are carry trades, where hedge funds, I should say investors, but typically investors will put themselves together in a business called a hedge fund. I'm not saying hedge funds are inherently bad. Please don't blame what's going on hedge funds. They're just another way to put investors together into a fund, like a mutual fund, an exchange-traded fund, and you have hedge funds. Different rules, different kinds of requirements to join one, but nonetheless, hedge funds were borrowing in yen to buy assets, which were low interest rates, to buy assets to pay higher interest rates, like treasuries. And now that now that the yen is getting stronger, which started last month when the Bank of Japan raised their benchmark interest rates, it started a little bit. It started a little bit of a chain reaction. The yen started to get stronger, and all of a sudden, it finally hit a sparking point or a tipping point where the yen accelerated quickly and the dollar got weaker against the yen. By the way, it's not that a currency gets stronger or weaker, it's how they trade compared to other currencies, is how we value a currency, whether if it's weaker or stronger. And, that started a carry trade where the investors had to buy back yen even more and get rid of their borrowings, their loans in yen, and it caused a lot of selling in higher priced assets like stocks. Liquidity event is what it is. We don't know if any hedge funds blew up yet or if anybody went out of business for it, but it is significant enough to be a reason of the day. I don't think it's the biggest reason of the day. And then we had some earnings announcements from companies like McDonald's and airlines that said we see consumers, weakening. And that's been an ongoing story, but consumers have still been able to keep the economy afloat. But then we got the non-farm payroll figures last month, and it said, "Wow, employment is slowing down." Now, didn't we all want the economy to slow down and for employment to weaken a little bit so we could see the Fed cut rates? I mean, the stock market, in large part, has been going up in the last year and a half on expectations of rate cuts. That and artificial intelligence. So I think those are the two biggest reasons why the market's gone up so much in the last year and a half or so. Let's say the last year. And be careful what you ask for because you might just get it. So now they have a weakening economy. Now investors are pooping bricks and they're thinking, wait a minute, we're going into a recession. Now, we don't know if we're going into a recession. We don't know if this is just a growth scare, maybe a mild recession, maybe just a sharp slowdown. It's tough to say. Only time will tell. But that's another reason. And now the Federal Reserve is appearing the Federal Reserve is appearing to lose control of the narrative that they're going to cut rates at the appropriate time. Well, a lot of investors are thinking the appropriate time was at their meeting last week, and now they're behind the eight ball, and they better start cutting aggressively now. They better do it. The Fed, in my opinion, unless something really calamitous happens, like an interest rate shock, or if banks just stop lending money, bank failures, give me something to get the Fed to cut rates. But as of now, I don't really see the Fed taking its marching orders from the stock market. As far as the Fed's concerned, stock market investors took risk. They're going to have to live with that risk. And you could scream and cry and sell stocks all you want and scream the Fed has to cut rates because we're in so much pain. But the Fed doesn't care about your pain. As a matter of fact, I think the Fed could look at this sell-off as a good thing where investors realize that, hey, markets are risky and we built up a little too much fluff into markets. And it's a good thing for this to come out because if the market, when bubbles pop, like in the year 2000, the tech wreck, that caused a mild recession. We don't want to see that again. So the fact that stocks could go down, lower the wealth effect, reduce consumer spending, these are probably things that the Fed would want. This is part of their design. So that's that. And those are the main reasons why the stock market is selling off. What was the exact tipping point? I think it was just the addition of all these issues that we just spoke about. And now everyone's wondering, should we buy now? Is this a bottom? Look, this sell-off is, it just started. Now, it doesn't mean it's about to end. It doesn't mean it's going to go on. Maybe the sell-off is over already. Maybe it's not. But if you're a long-term investor, this shouldn't be a big deal. If you have money set aside, the cash that you need for near-term financial obligations a year or two away already, if that money's out of the market, set aside in cash, you're okay. These sell-offs, which happen all the time, are only a problem for people who invested too much money and they took the money that they're going to need for the next 2 years, 1 year, 3 years, something to that effect. It's a problem for them if they put their money in the market because now they thought the market was a sure thing. And now you're wondering, what if NVIDIA doesn't come back? Remember, markets come back, but individual stocks don't always come back. I mean, if you take a look at Intel, what's going on with that stock, with that company, they're having a massive layoff, and that company is like, nobody wants to own it. But in the year 2000, when Intel went down, people were saying it's one of the best companies, and it was one of the best tech companies in the world. So you want to own that stock and put it away for the long term. You'll always be okay with it. And look what happened. Nobody's ever been okay with that stock again. It's made a lot of people look stupid. So is AT&T, for that matter. And I can think of others as well. So just because you're a long-term investor doesn't mean you're long-term right. Stocks, Intel was the leading technology company, the leading semiconductor company in the world, and now they're an also-ran. And long-term, no. Being a long-term investor actually hurt you, not helped you. So just because somebody says, I'm not worried about NVIDIA, I'm a long-term investor. Okay, then you're not worried. My strategy to you has constantly been, if you're up a lot in it and the stock has become a bigger portion of your portfolio to the extent where if it comes down a lot, it would blow a hole in your portfolio, you could consider rebalancing. And people who own an individual stock like NVIDIA probably own others like it. We talk about that. What not to do. Okay, what not to do is the usual stuff. Don't panic. Don't just run out and sell everything right now. A lot of these stocks that are down a lot, big tech stocks, for example, could have a bounce. They might not. If you're so heavily into these stocks and if they don't bounce, your financial future is ruined. Oh, shame on you, my friend. You did that. You have to make sure that you're not too heavily invested in these stocks. Now, if you don't have enough money in stocks, you've been waiting for an opportunity to buy some of these kinds of stocks that have been up a lot and they're finally down, this could be your opportunity. Could not, it could. Again, we don't have a crystal ball. But when I make money in a stock that goes up a lot and in a short amount of time, I like to take a little off the table and put that money into something else completely different. It could be out of stocks altogether. It could be cash. It could be bonds. It could be different kinds of stocks, small stocks, mid-cap stocks, something different. Because I like to add more diversification, typically not add less diversification to a portfolio. Did I tell you you can't invest directly into an index, but you could invest into a security that tracks or mimics an index? I just want to make sure I said that. So that's one thing. The other thing is, don't make hasty decisions. Don't rush. You don't have to rush. You don't have to say, I better sell this now and buy that now, make the money back quick. You might not make money back quick. And when you lose money quick and you're behind the eight ball and you're trying to make money back quick, you start gambling, you start throwing your money around, and you start wondering, why is it easy to be wrong? How many people expected a big bounce by the end of the day today in the stock market and didn't really get it, right? The market doesn't have to go up when you think it has to go up. Just like it didn't go down when you think it has to go down. The market does what the market does. It's not a mind of its own. It doesn't have a mind. You have a mind which you can control. So the other thing is, if you need to, you could now start to think about some tax losses. You could think about upgrading and the downgrade. Let's say you bought a second-tier tech stock or a second-tier drug stock or something, and it's down a lot. You could maybe sell that and get a bargain on a first-tier, best-of-breed kind of stock of company. Those are things you could do. You could also put in limit orders to buy stocks at prices even lower than where they are now. You could put a limit order in to buy a stock even lower than where it is now. This way, you start cheering for the market to go down instead of fearing that the market's going to go down. So lots of things to do. Panic shouldn't be one of those. If you were invested appropriately and you rebalance, and you take some gains off and not get too greedy, you've done okay. You're giving some back now, but giving back some gains in the market is part of investing because markets go down too. But if you're getting absolutely crushed and you are up like you doubled your portfolio, now that doubling is down by like a ton, maybe you did something wrong. Great that you get all the upside, but now you're frozen like a deer to the downside. Not a good thing. And now that means the market and the investments are dictating your next move, not you dictating your next move. I want you to get out of that. So if you need anything with this regard to this, any questions, you can reach out to me, send me a DM or an email or a phone call, what have you, smoke signals, and I will get back to you. Thank you very much. We'll see what tomorrow brings and have yourself a good evening.